Hello and welcome along to the Property Academy podcast by Opus Partners. I'm your host, Steve McKnight.
And I'm Andrew Nicol.
And today's show, we're talking about new builds versus existing, which goes up in value faster. Now, I have finally got the data. It's been about 5 years where I've been thinking, oh, we should go get some data and look at what goes up in value faster, new builds or existing. And
that's about the normal timeline it takes you to do anything I ask you to do.
Yeah, pretty much. Well, I've spent about $10,000 of Andrew's money to get the data. You knew this. I told you it was 10K. Don't look shocked.
It's for the fans.
But the thing that's really important is that no one has ever gone and actually got the data and looked at new builds versus existing properties. Do they go up in value at the same rate, or are new builds faster, or are existing properties faster? Now, I've just got the data. There's a lot of it. And this is going to be our first cut, our first reaction to it. We'll do some more episodes in the future, diving in a little bit deeper.
So Ed genuinely hasn't shared any of the results with me, which is quite confronting because I've had 11 years of this business recommending new build investments to people. And if he tells me that they're a terrible investment, well, that's going to be pretty bad news.
Well, especially if we're putting it out on YouTube. And I think one thing just before we jump in is some people might think, well, these guys are clearly going to be biased because you guys recommend new build properties. You sell new build properties. And so you're just going to tell me that new build properties go up in value faster. So how can I trust any of this? And I think that's a really important point. So if you guys are watching on YouTube and you think we're being biased at all, let us know down in the comments and call us out about it. The other thing that I'll mention as well for you guys listening on the audio version of this podcast is that I've been crunching this data with the guys from CoreLogic. So they've helped me out. And they have their own podcast, the New Zealand Property Market Podcast, and they're going to be talking about this data. So I can't come out here and pretend like I spent 10K on some data and that it shows that new builds go up in value 10% faster every single year than existing properties, if that's not the case, because they've also got a podcast where they're going to be sharing the data. So I've got to be honest with you guys. So just before I show you the numbers, Andrew, what do you expect to see when I show you new builds versus existing and their relative growth?
I expect to see pretty similar results between new and existing.
Okay. And for some people out there, they say, oh, well, new builds can't go up in value as fast as an existing property.
You hear it all the time. You hear things like, new builds like buying a car, right? The second you drive it off the lot, it's gone down in value by 20% or something like that. If I sell it again tomorrow, it's not as valuable because it's not as new. And I kind of get the sentiment, but we're not talking about a car, we're talking about a house. And over time, of all the data we've looked at, so many things might have an impact in the short term that really don't have an impact in the long term. So my money's on it, hopefully not having any difference.
And based on that, I think some people would expect that maybe new builds will go up in value 2 or 3 percentage points slower per year compared to existing properties. So let's start by specifically just looking at new builds. So these are all of the properties that were new builds in Auckland City in 2008, right?
So can I ask how? So you've got the purchase price, and then how do you measure the value after that?
So we're looking at the annual change per year. So what CoreLogic's done is they've looked at all of the properties that were newly built in 2008. We've looked at the average value of them, and then every single month we look at the estimated average value of that, and then we're looking at the annual change. Now, the trouble with most of this data, and I'm probably getting a bit technical too quickly, is that once a new build is a new build in 2008, it's no longer a new build in 2009. So if you sell that property again, in most data, it will not come up as a new build. That's why no one else has ever done this analysis before. And that's why CoreLogic were like, yeah, it's going to cost you 10 grand. And I've got to go through the lawyers in Australia to make sure the data is actually good.
So they've actually managed to keep tracking that property, even if it's changed hand multiple times.
Yeah. So these properties could have been sold again and again and again. And in fact, the estimated value is based on that. And what we see is that new builds have gone up in value. So if we take an extreme example, like in the 12 months to September 2015, those new build properties that were bought in 2008 went up by 22.5%. Now, it's not always like that. If we look more recently, in the 12 months to June, those new builds went down by 14.6% because it was a really, really bad market. But we see that, yeah, there are some times when new builds actually did go up in value. And in fact, a year after it's not like they went down in value. They were going up by 6.4%, 2.8%. So, we're not seeing that car effect. So let's compare that to existing properties. Are you nervous, Andrew? Are you nervous? Are you nervous?
No, I don't get nervous.
Okay. This
Holy
is
moly.
existing and new builds. So you just said holy moly. What's your first
So, yeah,
reaction?
sorry. For all the podcast listeners, you're basically seeing an identical graph.
They're pretty similar, right? So for everyone watching on YouTube, new builds are the dark line, existing properties are the light blue line. And they pretty much go up and down like roughly the same. They're like two lines on top of each other. Now, you will see the new build line jump up and down a lot more in this analysis. That is simply because we're looking at about 400 new builds compared to maybe 8,000 or 80,000 existing properties. So if you have a smaller sample size, the data's going to jump around a little bit more. That doesn't mean that new builds are more volatile. It just means that we're looking at different sample sizes.
Right.
So just don't let that distract you. But what we see is that sometimes, existing properties have gone up in value faster. So if you look at the 12 months, like to December 2011, so between 2010, 2011, in this specific set of data, the existing properties went up by 5.6% and the new builds went up by 1.8%. But in some other times, we see that like in the 12 months to September 2014, new builds went up by 11.6% and existing properties went up by 6.6%. Now, I wouldn't read too much into that because it's just that, there's some volatility in the data. But the basic trend is very, very similar. Now, you might say, okay, Ed, well, what's the difference in Auckland City at this specific time period if you average it out? So in this specific data, the existing properties went up about 0.6% faster per year than new builds. Now, what that means is that if the existing properties were going up by 8% per year, the new builds were going up by about 7.4% per year. Now, some people would say, well, isn't that case closed, Ed? Existing properties go up in value 0.6% faster. I wouldn't call it case closed at all because we're looking at one specific year. All of the new builds in 2008 versus all of the existing properties in 2008 in Auckland City, which is not the Auckland region, but a very specific part of Auckland. So this is just one experiment. This is one specific situation. We've got to look at a whole heap to try and identify the trend. And in fact, if we look at another city, we're now looking at new builds in Christchurch, again, starting in 2008. And what are you seeing here, Andrew?
So here you're pretty much, again, seeing the same thing. You've got times where existing properties seem to be going up slightly faster, just very slightly. There was a period where it was significantly faster. That was in about, mid-2013. But other than that, the trend is pretty much the same. Like nothing worth writing home about, saying it's definitively one way or the other.
Yeah, and in this case, the difference was new builds actually went up in value faster, 0.2% per year compared to existing properties.
And the interesting thing about that is that was over a time, or there's a time frame within Christchurch where you had a whole lot of rebuilds because of the earthquakes, and there was so much media about there being an oversupply and too many properties, too many new builds coming onto the market. The data does not show that at all.
And it's quite funny, actually, because I was talking to Nick Goodall from CoreLogic as we were crunching this. And he said, Ed, I'm not sure if this data really shows what you want it to show. I said, what do you mean, Nick? And he says, I thought, if you guys are going to spend 10 grand on some data to look at new builds versus existing, see which goes up in value faster, you guys must be pretty confident that new builds are going to win, that new builds are going to go up way faster, and that's why you're spending the money on the data, so you can go and say, buy a new build off us. And I was like, oh, no, Nick, I'm actually really excited about this, because this probably shows exactly what I thought, which is that whether a property is a new build or an existing property, that probably doesn't matter as much. What matters is the region you buy in. What matters is the suburb you purchase in. What matters is the yield of the property you're looking at. There are all of these other factors like land size, like whether it's a new build or an existing property, like the number of bedrooms it has. Once you get above 2 bedrooms, it doesn't really matter at all. there's all of these factors that people think are important, but actually are not that important.
It's funny. I was talking to one of an investor who was working with one of our financial advisors the other day, and they were just having some last minute jitters. And so the property partner asked me to give his investor a call and just talk through why I'd selected that property as a good investment. And I was having a conversation with them, and they said, "Don't you think this would matter? Don't you think this would matter?" And it was things like, north facing. Or how far away the car park was from the unit. I mean, these weren't the real things. I'm just thinking of them.
Oh, what were the real things?
I can't remember. Anyway, I said to them, it's amazing the amount of considerations that we have when we're looking at an investment that really have very little impact overall. The biggest thing that has an impact is whether or not you actually invest or not. And like you say, the area that you're buying and the type of property, whether it's an apartment or whether or not it's a townhouse or a house. And all these things can just get in the way and cloud our judgment. That's why I kind of imagine there might be a slight difference between new build and existing, but nothing substantial. And certainly that's what the data shows.
Yeah, now when you average it out, and I've looked at about 10 different areas. So I've looked at Hamilton and Porirua City and Wellington City. I've looked at Lower Hutt. I've looked at Waimakariri and Selwyn District. So I've looked at about...
You've covered some really good ground. Not $10,000 an area, though.
Well, it's not 10,000 an area. No, it's 10,000 in total. And Nick Goodall's done me a good service at CoreLogic. Big fan. Hi, Nick. And when you average it out over just the two time periods that I've looked at, so new builds in 2008 and new builds in 2013, there is a small difference. It works out to be about 0.6% per year on average. Sometimes new builds are going up in value faster, sometimes existing properties, but existing properties in this data set are beating new builds by about 0.6%. And I said to Nick, what do you think this is? And he said, well, you've kind of got to say, well, how is the data being calculated? And he said, one thing that's not being taken into account is with an existing property, you can renovate it. And we are only looking at the value change in properties. So let's say you had a $500,000 existing property, you renovated it and then sold it for $600,000. So in this data, that would look like $100K of capital growth, but it's not. That value increase has come from renovation spend. So we're saying, okay, so that 0.6% difference is probably on the high side. It's 0.6% in this data, but if you were looking at properties to buy and assessing capital growth, some of that 0.6%, less than a percent per year difference, actually just comes down to the fact that existing properties are being renovated.
That's a really interesting consideration. Another question I've got for you. So
I wasn't done yet, Andrew.
You can come back to your thoughts. So say in a place like Auckland, for example, they might be building a lot more apartments at any particular time than what is in the market being transacted at the moment. Would that have an effect on the new build growth?
Not in this example, because we're just looking at what's called residential dwellings,
right,
which are generally standalone houses, sometimes townhouses, depending on how the council assesses it. But generally, we're just looking at the same type of properties. But what wouldn't be taken into account here are different suburb growth rates. So let's say we're in Christchurch. Maybe all of the new built houses are being built on the outside of the city, where there's a lot more paddocks and opportunities for greenfields development. Well, that would say, well, maybe the new builds are going up in value. I mean, in this case, they actually went up slightly faster, but let's say the new builds weren't going up in value quite as fast. Well, is that because it's a new build, or is it because it's on the outside of the city where property prices don't grow quite as quickly? Maybe if you bought a new build in an inner city suburb that was in an area that was growing quite quickly, you might beat the market again. And so we're looking at quite small differences in capital growth. And that's where you say, well, okay, it's shown in the data, but in terms of my actual investing decision, that's probably on the high side and you'd want to adjust that down.
And just going back to your comment before about renovations, that also made me think about maintenance costs. So let's say you've got two properties side by side, an investor just buys one of each just to hedge his bets. Let's say the existing property goes up slightly more, but you've got to pay a whole lot more in maintenance. Like, let's say the small amount of difference might work out to be $1,000 or $2,000 extra capital growth on that property. Well, if you've got to pay 20 grand or 30 grand to replace a roof, all of a sudden, is it really worth it?
Yeah, that's where you start to say, well, even ongoing maintenance costs, okay, I might get 0.4% or 0.2% more capital growth, but if I've got to spend an extra $1,500 or $2,000 on maintenance costs per year, is that really worth it? I suppose what we're kind of coming to is the decision about whether to invest in a new build or an existing property does not actually come down to capital growth rates. It's not about which is going to increase in value faster. It's about all of those other factors, about what is going to be the right investment strategy for you. Do you want an active renovations-based strategy, which we call the BRRRR, or do you want the more hands-off, lazy, build and hold strategy? We just build a house and then wait for it to go up in value. And the other thing which I just want you to talk about in terms of return on investment, this also doesn't take into account different government regulation.
Yeah, so we don't have DTIs yet, but they're coming, right? But right now we do have LVR restrictions. So you almost need twice the deposit to buy an existing property than you do to buy a new build, because 20% for a new build, 35% for an existing property. So if you're thinking about getting the same capital growth or even a slightly higher capital growth for an existing property, just call it the same, you're having to put twice as much deposit down almost to be able to get that capital growth on the existing property than you would a new build.
Yeah, and so if you're using a lot of bank financing, right, then that's where you might say, well, do I buy 2 new builds or do I buy 1 existing property? And especially when debt to income ratios come in, that's when that conversation or that thought process comes in. Now, if you were buying a property with a whole heap of cash, that wouldn't be a consideration because you're no longer worrying about deposit requirements or mortgage requirements. But if you're at the start of your journey and you need to take out, you don't have a lot of cash, you've got to take out a large mortgage to invest, that's where you might say, well, do I buy 2 new builds or 1.5 new builds, or do I buy 1 existing property? Well, if the capital growth is the same or very similar, which is what the data says, that's when you might say, well, if I'm a hands-off investor, I'm going to go for 1.5 new builds. If you're a renovations-based investor and that's what tickles your fancy, that's when you say, well, nah, bugger that, I'm still going to go for existing properties. But it's quite funny how you kind of look at the data and you say, actually, the capital growth, pretty much the same. Small difference, 0.6% on average across the data we've looked at. We need to dig into it a little bit more. That's probably on the high side, probably closer to, 0.2 to 0.4% if we were going to ballpark it. And then you say, well, how much of an issue is that? Maybe I'm just going to choose the right property investment strategy for me. So the honest truth is, yeah, there is a little bit of a difference, but probably much, much, much smaller than most people think. Right, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. Really does help us get the message out to more people. If you're listening to the audio version of this and want to see my graphs, just Google Opus Partners YouTube. It'll be the first thing that comes up. And if you are watching on YouTube, make sure you hit the subscribe button. We release new videos on here every Monday and Wednesday. Thanks for listening to the Property Academy podcast. I'm your host, Stephen Knight.
And I'm Andrew Nicol.
We're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.